Hello and welcome to Closing Trades right here in ET Now with me, Asha Faridi, Nikunj Dalmi in the studios. And what a quiet market this is turning out to be. Much unlike yesterday when we were quiet for the large part of yesterday's session and then saw a late trade pickup, but no signs of a pickup just yet. Just been circling around that 19,400 for the large part or better part of today's trading session. In bits and starts, of course, there are an odd cap goods, telecom plays, infrastructure, realty, which are holding out. Adani names once again are propping up in the green. Look at the tear that you're seeing on a BHEL, for instance. That stock is holding higher by 8.5%. GMR Infra for a second consecutive day has been very, very strong. And you are seeing some decent moves come in from a Tata.com as well. Having said that, many large caps continue to be under pressure as well. You're not really seeing much of a move sectorally by pharma, by oil and gas, or for that matter, even technology, which is very, very sedate in today's trading session. So yeah, pretty much a no-go, and you're wondering where the next cue for the market is going to come in from.
It's not bad if you just move away from the Nifty, because the mid-cap index today is at an all-time high. And that is what the exciting part about the market is. The breadth is, you can look at the names which you would say in the F&O market and say, okay, these are the ones which will make trader and HNI investors heavy. BHEL, 10% higher. Why? One small order, 10% higher, that's BHEL for you. You got L&T Finance, again, very large, very liquid, 4% higher. Mahindra & Mahindra Finance, 4.5% higher. Escorts, 2% higher. Hotel stocks, GMR. So it's not like a hollow market if you really move outside and just shift focus slightly. Don't look at the center, don't look at the Nifty, don't look at the Bank Nifty. Slightly off center, mid-cap stocks, yes. Small cap stocks, yes. So it's not a bad market. And frankly, if you ask me, the market has the ability of the market to shrug off bad macros, bad flows, everything has pleasantly surprised everybody.
Oh yeah, absolutely. In fact, I'm just looking at the individual movers as well. Look at Indo Amines, for instance. After GPCB revoking that closure order for the Vadodara plant, that stock is actually holding up a good 9%. There's a car trade wherein Nomura has maintained a buy target price of 678. That stock is pumping up in trade. Or for that matter, even Oro Pharma, wherein Citi has downgraded it to a sell, attributing to the kind of run-up that the stock has seen year to date. But at the same time, they've upped their price target as well to about 750, though the stock is a little bit under pressure. Adani Power, once again on a tear, up 4.5%. They're targeting about 21,000 over 21,000 megawatt capacity by FY29. The target, of course, includes that 1,100 megawatt inorganic capacity as well. And they're also saying that the net senior debt is seen at 26,690 odd crore rupees in FY24, which is a little lower than what the market was earlier anticipating. That said, a lot of other stocks as well which are holding out in trade. Bharat Forge continues to clock in new high after new high. After yesterday's phenomenal move, another 2% up in the green for this one. Nomura is maintaining their buy with a target price of 1157 now on Bharat Forge. That stock already a 4-digit counter now. GMR Infra, L&T Housing Finance, United Spirits, a lot of the broader market contenders are holding up while the Nifty is completely sedate. But Kunal, shall we not talk about the Nifty, talk about the mid-cap index?
No,
Will the Nifty remain quiet for some more time?
In fact, today, actually, for the first time in the last so many weeks, we are seeing some negative signals emerging on the index.
Okay.
So it's not just the price movement, but on the indicator fronts, many of the indicators have started to get back into, they went into a neutral territory, positive to neutral territory since the last 2-3 weeks of this market correction from 20th of July. But for the first time today, we are seeing the indicators come into that slightly negative territory or breaching that neutral territory for itself. So that could probably be a point of concern. The other way to look at is, two important data points. In the morning I was flagging off that there was a slew of short covering in terms of open interest. Now, if such a strong short covering of 10%, 15% happens into the index, we expect the index to propel on the upside with a second round of short covering. But we've not seen that happening today for the Nifty as well as for the Bank Nifty. And the most important part is the premium for the indices are shrinking, and we are almost at a discount on the Nifty futures. I don't remember last time we've actually seen discount in a running month for the Nifty in the last, I think, 5-7 months at least.
I've not seen this year only.
Yeah, for the
first time
in a running month. Yeah. In a running month, we've not seen the index into a discount.
No, otherwise you've not seen the index. I mean, Nifty futures have not come at a discount this year itself. I mean, 100 point was the average.
See, on the expiry week, we tend to get into the discount. But week, I mean penultimate week towards the expiry, I've not seen that happening phenomena.
So if there is a discount, it means that the traders are of the view that I want to pay less for a long position. When you want to pay less for a long position, you essentially are bearish on the market. That is what we should infer, right?
Yeah, so basically carrying long is more profitable because then you are, if you're rolling over, it becomes, you buy the next futures at a discount. But markets generally don't, go into the favor of an easy trade. And whenever we see something which is in favor completely of bulls, we tend to take a contra position.
Actually, 19,400 is still there. It's not that you've gone below 19,300. Nooresh, Kunal is for the first time making a point that you got to watch your steps. Do you think it's time to watch your steps?
So in terms of premiums and discounts, although we do not have large dividends as such, but June to August is a period of time where there are a lot of dividends on the stock which does not get adjusted in futures all the time. So the September future is still at a 80 to 100 point premium. So for now, it is more like the market is not going anywhere. So I would not take a decision purely on the, premium or a discount, because we've had periods of 150 point premiums and we topped out in the next, 5-10 days also last time around. So the view is simple, let the prices confirm. And for that, it is 19,600, 650 and 19,250 to 300. Till the time we don't go beyond this, we are still stuck in a range and the broader market continues to do well. And it's not just the small caps or micro caps doing well. You have the mid cap index getting higher. You have the small cap index getting higher. Even the Nifty 50 equal weight or the Nifty total market cap or Nifty 500 has not seen much of a decline. It is purely because some of the heavyweights on the index have zero trend. So if you add up HDFC Bank for almost 12 to 15% of the index, you have 10% Reliance. Then you have another 5-7% coming from ICICI Bank, and then the whole of IT. So you have almost 40 to 50% of the index which has zero trend and almost at the same prices. So till the time we don't get one leadership stock on the downside or on the upside, we are in this zone of 300, 400 points. So would wait for price action to change to shift stance. For now, continue to focus on the broader market.
Ashi, Anand joined just now. Let's take our conversation forward, understand what he makes of the current market setup, where is value in the market and how is he investing. Ashi, great to have you, Niti. Now, thank you for joining us. Let's understand and let's start with the market construct. What is your view and where do you think we are headed in the near term?
Thanks a lot for having me. So just in terms of the market construct, I think largely in line to what you guys have been discussing on the channel. What we have had is a fairly strong move that we've seen over the last few months. Right now, this has happened on the back of interest rates kind of peaking, inflation peaking. And that was a clear headwind for the market, which got removed. And you saw the big move happening off that. Now, with this move, valuations are no longer necessarily cheap. And especially if you're looking at the core large caps, right? You still have certain clear headwinds for kind of growth. The global economic environment is clearly one headwind. Consumption is still slightly kind of weak. And inflation and interest rates, while having peaked, aren't yet reducing. So given that kind of construct, it doesn't really lay the foundation for a very strong bull market until some of these headwinds don't go away. But that said, what we are very clearly seeing is India is starting to look extremely attractive from a longer term perspective relative to all other major global markets. So you're seeing this in terms of the interest that you're seeing from FII flows, I think over $15 billion so far this year. You're clearly seeing India becoming more attractive as compared to China has a number of issues, right? So it's becoming very difficult for people to allocate money to China. Europe is relatively weak. The economic outlook out there is quite low. So India is in this context benefiting a lot, and this should also help prevent the markets from falling too much. So I think at least when you're looking at the larger cap indices, you're probably going to be in an extended period of a bit of a range-bound move until you don't see either growth starting to kind of come back and clearer signs of growth coming back, or there's no kind of major negative kind of event that could happen that could force a larger correction. And I think the one thing that we are watching out from that perspective in terms of a potential negative news flow is in terms of some of the developments that we're seeing happening in China, especially on the real estate side.
I wanted to pick up on the point that we were chatting about when you were last on ET Now. Your PMS strategy, wherein you have invested exclusively in some of the platform companies. Now, most of these stocks, barring a few like Nykaa, etc., have already doubled from their previous lows, right? Do you think a large part of the rally is behind us, or do you still find these stocks worthy for long-term investments?
Aisha, so we're actually extremely positive about this space. We've actually, the way we look at it is it's a quasi-private equity strategy that we've launched. Our timing ended up being very good. We launched it pretty much close to the bottom. But if you're effectively just looking at what makes us so confident of long-term value creation in digital platforms, market capitalization growth is always driven by business growth. These are the fastest growing businesses by far. So if you're looking at a kind of digital platform strategy, we have investments in companies like Paytm, Nykaa, Zomato, Policybazaar, etc. These are the fastest growing financing companies, fastest growing food delivery, fastest growing shopping spaces. So growth is something which I think is very clearly understood, and there's very clear value migration happening towards this particular part of the segment. We built long-term models, and if you just look at the penetration rates in India, look at certain underlying dynamics in terms of the foundations for longer-term growth, the ability for these companies to continue to compound revenues at over 25% from a longer-term perspective is very clearly there. The misunderstanding, according to us, in terms of the listed market space is with relation to the longer-term profitability of these companies. What people don't necessarily understand is the sheer quantum of current expenses that are really just short-term in nature. As in, these expenses are primarily linked to the current hyper-growth phases that these companies are on. There are four distinct phases of the evolution of a digital platform. When you're in stage 1 and stage 2, you're trying to change consumer behavior, and there are very large amount of expenses to drive this change of behavior. As consumer behavior gets changed, and you're starting to see this, you can actually ramp down these costs quite significantly. And someone like a Zomato introducing delivery fees, if you're seeing someone like Paytm earlier used to have cashbacks, there you no longer get those. A lot of the costs that were involved in trying to ensure that consumers participate on a platform, those can be rolled down quite significantly. And also various monetization levers can be, there are various new forms of monetization that come up. Now, this can lead to very healthy profitability over the longer term. And according to us, a combination of much above industry growth along with a shift towards profitability should lead to very attractive value creation.
Right. Sure. Ashi, hang in there. Lots more to talk about with you, but we will slip into a very quick break with news that we're still pretty quiet in the index, and it's the broader market once again, which is extremely lively.
Well, you cannot take your eyes off from BHL. I've always wondered why this stock is going up, but my wonderment can remain wonderment for a long period of time.
Small wonder.
But I've been liking the stock, and I think it looks very attractive on the charts. I remember, I think post results, the stock was just staggering at the 100 mark. There was a touch and go movement towards 103, 104 for BHEL. Then it came down towards 95, 96 odd levels. But then, the last few days, the stock has been steadily seeing a buying. Today, the stock has seen a huge breakout. This is, I think, a major multi-year breakout for BHEL, crossing that 110 odd levels. And for the first time, I think, if I remember, I think the stock was also in upper circuit of trying to break past about the 10% level. So again, a strong breakout for BHEL, expecting this up move to continue, as well as expecting this to be more of a multi-month uptrend, not just from a short term.
There is a big spike in Bharat Forge, and guess what? We spoke to the management over the weekend. We'll play an excerpt out, and the Bharat Forge, the problem has been, it's been a very deeply cyclical business, because it started as an auto component company. They were making components for trucks and cars. Then they started exporting. And when they started exporting, there is cyclicality which came into their business because of Europe, 2008, COVID, and then what happened because of war between Russia and Ukraine. Then they started diversifying. They moved into industrial design. And that also was cyclical because the capex cycle is never linear. Then came the third leg, they moved into aero, and now defense, which is 10% of the business. Now in defense, there is no cyclicality. In defense, you always have a linear move. India will need more defense. You need to modernize, you need to service. And the mainstay for Bharat Forge now, what the management told us, was that they would be getting a lot of business from maintaining some of their drones and the trucks and the other defense equipment, what they're planning to do. Let's hear out the management, Amit Kalyani, on the way forward for Bharat Forge. One number which markets and shareholders always look at is ROS.
Yeah.
Your ROS has fluctuated in last couple of years. Is that largely because of investments?
It is because of investments. And please understand, it took 12 years for us to incubate our defense business. It will take less than that for our EV business. It has taken less than that for industrial. Our overseas businesses have taken longer because nobody could anticipate COVID and what it has done. But, our ROC targets are well in excess of 20%. And I'm confident that by 2025, we will be well in excess of 20%, 22, 23% or so.
So does that also means that you're assuming your global business will come back? It has to normalize.
It will come back. Of course, it will come back. Our European business will be profitable this year, and our US business will, head towards profitability by the end of this year, and by next year, that also should be profitable.
So what Bharat Forge has achieved in last 5 years, you're likely to achieve that in next 2 years?
I hope so.
Because for you, all your businesses now are filing full cylinders. You're ready. Capex is done, and now it's really operating.
Capex is done, but we also need to do more capex, as we announced in
the last quarterly numbers. Yes,
we'll invest slightly over 1,000 crores in the next 24 months or so, in both our conventional business, in EV, in aerospace, and in industrial.
What are you doing to increase the moat around your business? Good companies always focus on that. How can they make the company more distinctive?
So we are increasing our moat by doing 3 things. One is, in our existing business, we will become the last man standing, which means the highest quality, the highest capability of engineering, most competitive cost-wise, and unmatched financial strength. In new areas, we will be lean, mean and hungry, and we will use technology to drive our business, and we will continuously reduce cost, and we will use technology to reduce cost. And we have an amazing technology platform that we have in place now, which is going to help us increase our productivity quite dramatically while reducing cost. So that is what we will do to increase our moat. And the last thing you have to do to increase your moat is increase your customer affinity or your customer relationship. And that has to be through engagement, bringing value to your customer. And that is something we do through technology. And that's what we do in this building and the next building.
To get in your views here, what is it that you're making of some of these companies which are in a transformation stage, if I can call it that? Prime example being a Bharat Forge. Ashi?
Sorry, hey, yeah, I didn't realize you'd asked me the question. So, I think the one thing which is very interesting when you're looking at a lot of these auto anchors and companies such as Bharat Forge in the transformation phase is defense is clearly a very, very interesting opportunity for these companies. What you are looking at is India has the largest import bill of defense equipment in the world. I don't know if a lot of people know this, but we're actually larger than the top 2 or 3 other countries combined. There is a very strong strategic need to indigenize defense because a lot of our defense was Russia dependent. And as Russia is going through various troubles, you need to kind of de-risk from that from a strategic perspective. You're also having issues around geopolitics with what's happening with Pakistan, Afghanistan, China also becoming a lot more aggressive. So you're in a need to increase defense spends and you also need to de-risk, and therefore you're seeing a lot of traction in the Make in India program. Now, this is very beneficial for both PSU kind of defense peers as well as companies such as Bharat Forge, etc., which are starting to build out their defense practices. I think for Bharat Forge, this is also particularly important given the fact that they do get a reasonable part of the business is still dependent on internal combustion engine kind of lines of business, and that is something which is at risk as EVs increase. So they do need to kind of find new lines of business, and I think defense becomes very attractive from them from that perspective.
What is your view then on these richly priced defense stocks? When I say richly priced defense stocks, Mazgao, Kochi, HAL, suddenly they're commanding P multiples which are even north of ABB, Siemens and Thermax.
So it's actually quite difficult. Honestly, it becomes very justified to justify those kind of valuations. But what becomes a little difficult is in terms of how lumpy these businesses are. So HAL, for example, the Tejas program is extremely important. Now, if they get incremental large orders on Tejas, you can actually see a very sharp, sustained up move in revenues. And from a longer term perspective, you could potentially start justifying some of those multiples. But on the flip side, any kind of weakness happening on the Tejas platform and the whole story could really go for a toss. Some of the shipyards are very dependent on specific kind of orders, and some of these orders are so large that if you get it, you can really justify some of these multiples because it can lead to a ramp up of revenues and margins, which kind of do justify it. Now, what's happening is in terms of the current valuations, you're really factoring in all of the positives and assuming everything plays out ideally, and you really aren't justifying any of the risk, which is why we at least are staying away from these pure play defense contractors, which have larger lumpy businesses. I think the only stock we have in our portfolio is Bharat Electronic. Out there, it's the orders are much kind of smaller and it's a lot more diversified. But these pure play defense PSU companies, it's a bit of a 0-1 in terms of how some of these orders play out.
Sure. Ashi, great to have you on ET Now once again. Thanks as always for dropping by.
Thank you so much. It's a pleasure.
Okay, that's the word coming in from the house of Valcreate Investment Managers. Let's take stock of what the market is up to, and still a no-go, at least at the index level. We're still flat, though little bit of a drift down is what you've seen from where we were just about half an hour back. So absolutely flat right now with a negative bias at 19,395, a downtick of about 22 points on the futures. What's putting pressure? BPCL, iShares, SBI, TCS, Bajaj Finance, FinServ actually, I stand corrected, ICICI Bank, TechM. Some of these stocks are caving in, as are others like in Infosys, ONGC, Reliance, and now even Indocent, Tata Motors, as well as Wipro. But Kunal, let's get some closing ideas on that note.
So Bharat Forge is something which looks attractive. Now I think the futures as well as the spot is trading above the 1,000 mark. So would be something from an interesting trading perspective. We'll be looking to buy, expecting the stock to move up towards at least 1,040 to 1,060 over the next couple of days. Right.
Nooresh, what about your closing ideas?
So that would be a buy on LIC Housing, which is setting up for a multi-year breakout. The stock has multiple tops around 440 levels. We've come to 420.25 today. Plus the stock is ex-dividend, so closer to that adjusted level, it would be 430 to 435. If that breaks out, could see a big move. So looks positive for a medium-term outlook.
Okay, let's take a very quick break on that note. When we come